Welcome back to Mortgage Chicks with Hot Tips. I'm Diana Harvey.
I'm Elizabeth Hall.
I'm Kim Hairsted.
I'm Cindy Walker.
And I'm Stacy Van Skank.
Today we thought we'd bring you some information from one of the top people at VanDyk Mortgage, John Barnes, who happens to be our Chief Secondary Officer. John, welcome to Mortgage Chicks.
Thank you, ladies. I'm happy to be here.
So could you start by telling us what exactly is a Chief Secondary Officer?
I can try. My wife doesn't even know that when she tries to describe what I do to my friends and to our friends and family. So, the general gist of it is anything that pertains to mortgage rates or where a borrower is going to make their payment long term, that falls under me.
Okay, so that kind of explains to people why we reached out to you today to talk about mortgage interest rates. Could you start by telling us how they're determined?
Yeah. So everyone's heard of Wall Street, bonds, stocks. Most common thing that's traded on the New York Stock Exchange. There's an instrument out there called Mortgage Bag Securities. And what these are they're the exact same as traditional bonds that you see traded out there, except they're all backed by the mortgage loans that we do on a daily basis. As part of that, there are investors on Wall Street that say we want to invest in housing. And the easiest way for them to do that is to actually buy these mortgage-backed securities. So when each of you ladies originate a loan, odds are if it is a FHA, VA, USDA, or a conventional loan, it's going to end up in a mortgage-backed security. These are then traded on Wall Street, and Wall Street then dictates a price to us of what they're willing to pay for these at certain interest rates that are out there. So the price is really dictated to us in terms of for this interest rate, for that interest rate, here's what Wall Street is willing to pay for that. And that then gets passed through to the consumers.
So why are these rates going up right now?
That's a tough question to answer, honestly, because there's a lot of factors into it. There are far smarter people than me out there who can honestly give you an assessment. If you do a quick Google search, you're going to come up with a million reasons. It really boils down to one thing, and it's fear. There's fear out there of inflation, that we have pumped so much money into our economy over the last 10 years, and especially in the last 2 years with COVID and the stimulus checks that are going on, with some of the efforts that the Federal Reserve is making, that it has caused the cost of all goods to go up. And that generally is not a good thing. So there's fear that that is out of control and that the Federal Reserve is going to move to pull money out of our economy as part of that. The fear piece of that comes in with the Federal Reserve has not come out and bluntly said that what their plan is for this. They plan to increase rates, but they haven't said how much. So there's that fear out there. There also is the fear of what's going on in Europe right now between Russia and Ukraine. That is a complete wild card. And on top of it, you've got a lot of indecision in terms of what the economy is going to look like here for the rest of the year. You have increasing interest rates paired with lower inventory on the mortgage side. Is there going to be enough supply versus the demand that's out there? So there's a lot of factors that are playing into it. And right now, a lot of it is just fear driven. We should see some stability come to the market here in the coming weeks and in the coming months. But right now, it's a case of what's out there. Let's move on it quick to make sure we don't lose any more ground.
John, can you tell us how the Fed affects the rate?
That is a fun one. So directly, there's only one way that the Federal Reserve can impact mortgage rates. And that's through their purchasing of mortgage-backed securities that I previously mentioned. They are an actual buyer. So when we mention mortgage-backed securities, think of it like a 10-year or a 30-year bond that's hanging out there. You buy into it for a certain amount of dollars, and you get a certain amount of interest back in return for that. When the Fed is doing this, they're doing the same exact thing, except they're trying to provide a flat platform to make sure that the price that's out there stays stability. So that's something called quantitative easing. And they've been doing this for the better part of 10 to 12 years now. Basically, since the crash took place, they stepped in and they've been trying to provide stability because housing, honestly, is the backbone of our economy. That is the only way directly that they can impact it, is buying and providing that stability of there always is a guaranteed price. It's going to be right in the middle of the park for buying these securities. Indirectly, there are institutional investors, there are other markets that anytime the Federal Reserve speaks in any fashion, even if it's a member, even if it's not a formal announcement from them, they're looking for any little tip in that in terms of what the Federal Reserve plans to do with their monetary policy. And they're basically trying to get ahead of the curve. They're trying to buy when everyone else is selling to try and get ahead of the curve, or sell when everyone else is buying to try and get a slight lead and make a few extra dollars in that process. So the fact that the Federal Reserve hasn't come out and laid out a definitive plan of here's what we're going to do with the federal funds rate to increase rates or to give us a little bit of cushion if we have to, that fear, that indecision that has come, that's the indirect way that they do it, because people are moving money in and out of each market. And it's not just the US markets, you've got the European, the Asian markets. People are moving money back and forth, basically trying to make sure they're getting the best return possible they can.
Makes sense, sort of.
So John, question. When we talk to our customers about mortgage rates and they're like, well, how come my neighbor got this interest rate and how come so-and-so got that interest rate? What makes those interest rates different? What is it that you guys do or that guides those interest rates to make them different for each and every buyer?
Yeah. So there are different products, and each product comes with a different rate set. You've got conventional, which comes with one rate set. You've got FHA, VA, USDA. Each one of those are priced independently of each other. But on top of that, there's an added layer. So the mortgage industry operates based on risk. And it's an outdated, archaic system of a person with these characteristics has a higher likelihood of paying a loan back than a person with these characteristics over here. They haven't been evaluated in a long time, but these are called risk-based price adjusters. So a person with a 660 credit score who's utilizing max financing is viewed as a higher risk than somebody who has a 740 score and is at a 50% loan to value. That's basically where it breaks down of over the years, Fannie Mae, Freddie Mac, FHA, VA, USDA, FHFA, pick any acronym you want, put any combination of letters together. They've all kind of taken the numbers that they've done in the past and they said these loans are viewed as higher risk. So as a result of that, they're going to end up with a higher interest rate. Doesn't seem fair, does it?
No.
Someone who's going to have a harder time managing credit or has had a history of having a more difficult time gets a higher interest rate in some situations. It's not entirely fair. But that is unfortunately the way that it has worked out. And the main reason for that is because when you get to the Wall Street level, they're looking at default opportunities of what's the likelihood that a borrower is not going to make their payments and we're not going to be getting interest on the dollars that we put in to buy this security. So as a result, you kind of see that shift. And there's also wild cards into it for property type. Buying a manufactured home or a condo is apparently a higher risk than it is buying a single family residence. Again, as I mentioned, a lot of these risk-based adjusters, they're incredibly archaic. They're from 30, 40 years ago in some cases, and they honestly do need to be reassessed. But that's one of the bigger driving forces.
Well, John, we've talked a lot about the Fed and quantum and mortgage bag securities, lots of big words, things that a lot of the regular lay people do not understand. And I get the question a lot is, what do you think is going to happen? What indicates there's going to be a raise to the rate? I mean, other than the Fed speaking, what is something that the average person watching the news or reading the paper might be able to read and go, wow, this means to me that there might be some volatility in the market as far as rates go?
Mm-hmm. The easiest thing they can look at, bad news globally typically means good news for mortgage rates. It's kind of sadistic that we sit here and we say if there's a flood or a hurricane or a tsunami or a war that breaks out somewhere, that's good news for mortgage rates. It's an unfortunate thing. Bad news globally means good news for mortgage rates. The opposite is also the case here domestically. So when you're looking at things here in the U.S., when you see jobs reports come in better than what's forecasted, when you see GDP numbers come in better than forecasted or better than expected, that typically is going to indicate that mortgage interest rates are going to be increasing. Because good news here in the U.S. means bad news for mortgage rates. That means things are going well. And again, it's that relationship of where people at Wall Street are moving their money. Of when things are bad overseas, they're going to invest their money here domestically in the United States. When things are good here, yeah, they're going to move money, but they might not invest in this market. They might put it in stocks or bonds, which might be more secure for what they need to do. So when you're reading the news, when you're looking at headlines, typically bad news, anything that you're seeing globally, it's probably going to mean interest rates are going to get a touch lower. And if you see good news here, probably means interest rates are going to go up a touch.
Now, John, I don't want to make you blush, but
Oh, no.
the mortgage chicks, and I think everyone at VanDyk Mortgage, we love, love, love you, and we respect you. And you are one of the smartest people I've ever met in my life. And when I started with VanDyk Mortgage, there was 3 people that were wow. As soon as I started, wow, these people are amazing. And John, you're one of them. So
Well,
with
thank
that
you.
being said, I want you to take out your crystal ball. No pressure here. But the burning question with everyone is, what do you see happening with rates this year?
Deep sigh.
Deep sigh.
Heavy sigh.
She gives me a compliment, which makes me feel like I need to give good news on this. Honestly, my crystal ball's broken. It's been broken for years. I can't tell what's going to happen outside of maybe tomorrow. I could give you a forecast. But what should happen the rest of the years is we should see rates continue to increase. I would expect the average interest rate when we get to the end of the year to be somewhere between 5 and 5.5%. And in all honesty, those are still phenomenal rates when you look at the long-term picture. I mean, I'm not that old, but I'm old enough that my first mortgage loan had a 7.5 interest rate, and then I had a second attached to it, which was 10.5%.
Oh, whatever. I don't feel sorry.
No, my first one was
mine was
18%.
Right.
Mine was like 9.5.
18% was my first loan.
You almost had me beat.
And that was probably with 20% down.
It was.
Yeah.
It was FHA, 18%.
Wow.
Whoa.
I'm old. I'm really old. I'm sorry. That was in 1983.
My parents couldn't actually get a mortgage when they bought their first home. They had to do an assumption from the previous owners.
Yeah.
And then borrow money from their parents in order
Yeah.
to make it happen. So rates should continue to increase, but you're looking at realistically a 5 to a 5.5% interest rate walking out of the year. That's worst case scenario. Ideally, I know everybody wants to have that rate that they can go and brag to their neighbor of, hey, I've got 4%, or I've got the counter side to that is what's going to happen when rates increase is you should start to see the value of homes start to plateau. Not decrease, but it shouldn't be this constant shooting up where you're constantly in competition and you're seeing your values increase every single day. You should start to see that plateau because it's not that interest rates are higher, it's that the buying power has changed.
Yes.
Now instead of being able to afford that $400,000 mortgage, you're only able to afford that $385,000, and there aren't going to be as many over offers or cash offers going on out there. So we should start to see some balance in terms of interest rates increasing and values starting to calm down a little bit. That will probably be late in the year. But that's kind of that inverse relationship of we've spent the better part of 5 years now quoting interest rates in the 3s and the very low 4s. And you look at those who weren't able to get in on that, okay, that's still okay. You can still get into your dream home. You still have a ton of opportunities out there with slightly higher interest rates. So it's not doom and gloom by any means to hear interest rates are increasing.
So, John, this has been amazing. You have actually helped us a lot because you've helped tell us where interest rates come from, how they're determined, why they're going up, how the Fed involvement comes to play. We've talked about adjustments to interest rates and why it affects some people more than others. Market conditions and what's happening. And actually, it excites me that you're telling us that the worst we're going to see is maybe 5.5. That's not as bad as 18.
No.
Or
Not
12.
at all.
Not at
Yeah.
all.
No,
we're okay
no.
with that.
And things look like that's going to happen and settle down to a more normal market.
Yes.
And awesome.
Well, thank you. And again, that normal market, I think, is what we're all looking for. Because
Yes.
Right.
I hear the struggles so many people are having in getting purchases approved, and I think that's what we're all looking for. Is just give us a little bit of stability, let us get our feet underneath us, and again, you five ladies are awesome, 100%, and I'm looking forward to see what you guys can do this year.
Well, thank you so very much for taking time out of your busy day to join us. And I know why Stacy admires you so much. You do a great job, and we thank you.
Absolutely. Thank
Love
you,
you,
John.
John.
Thank you,
Lots of
John.
John.
If you have any questions or suggestions for podcasts, please send us an email at mortgagechicks@vandykmortgage.com.
Please make sure to like us on Facebook at Mortgage Chicks with Hot Tips.
Please tune into our channel on YouTube and like, share, and comment.
And don't forget, we are also available on where you listen to your podcasts.
Thanks, everybody. You want to save this episode for sure. See you next week.